The purpose of this video in doing question 2 is to let us build up to doing a more detailed NPV analysis off of an income statement. What it requires is first the documentation of all of your assumptions and then the production of an income statement like we did for 3 weeks to start this class off. So Cam's batting cage is going to solve 3 new pitching machines. So I'm going to go ahead and document there's going to be 3 of them. Each of them will be depreciated for a total of $2,500 annually, which will be an expense on the income statement. He anticipates customers are going to be able to hit new balls out of these new pitching machines and expects 10,000 new balls to be hit, all HK. That's what I wanted. But his pitching machines and the outdoor facility are only open for 6 months during the summer. And when you come to his facility and you want to hit a new ball, it's going to cost you 25 cents every time you swing at a ball that comes your way. Now, just like Jim in the video over here, if Cam makes any money, he's going to need to pay taxes, and his taxes are going to be equal to 20%. God, I hate this keyboard. Of whatever it is that he earns. But in order to run this new machine, Cam needs a little teenager kid to run around with a basket and scoop up the balls. So that employee, because Cam is a cheapskate, is only going to get paid $10 per hour. And that person will work only 20 hours per week. And obviously they can only work those 6 months. Cam's nice enough, though, that every year he'll give a raise of 20% to that kid to try to encourage him to come back for the next 3 years. Sadly, though, he also, because he is going to be having more and more of these balls flying around, is going to need to get some more insurance to cover his liability. And that's an additional amount of $500. And it doesn't hurt us at all to put the year thing in here again. So the question that we have to really produce then is for years 1, 2, and 3 then, all HOW, let's make these all 10, see if that's enough. What will his revenues and expenses look like? Oops, that was too fast. Put them there. Okay, so year 1's revenues. How much new money will the pitching machines make are equal to 10,000 new balls. Each ball that gets hit is 25 cents. That 25 cents then amounts to his new revenues. If we look back up here in the problem, each ball costs 25 cents. To be able to hit 10,000 marginal balls every month. So let's just qualify this in here so that we know it's not just $2,500 for the year. It's actually $2,500 per month every month for the 6 months that he's open. Because I'm going to make my formulas constant later and copy them across, I'm going to put fixed references on all these so that I need to make them 15 then now. All right, let's make them 15 then. When I copy and paste across, it's still asking me, look in those original cells. So it's $15,000 every year for those 3 years. In order to run the machines, he's going to have to take on new costs of the goods to run. That is primarily going to be equal to this new kid that he hires and now pays. One kid gets paid $10 an hour. He works then how many hours a day? Did I not write that down anywhere? 20 hours per week. Sorry, it's not per day. He's only working 20 hours per week. So he's really only making $200 per week. But he's working for 6 months, but a month has 4 weeks in it. So it's $200 a week for 4 weeks per month for 6 months for the summer. And again, because I've got everything sitting in the same place here, I'm going to do that little fix locking so that I should be able to just copy and paste this across. So to run these machines, it's going to cost him $4,800. So the gross profit that he would earn is equal to revenues minus cost of goods, just like it was for assignment 1. But in addition, he's going to take on new costs, which we call sales, general, administrative, and that's the cost that he needs to incur to buy more insurance to keep this kid safe. So that's $500 per year. Every year he's going to have to pay for some new insurance, which then allows us to calculate our EBITDA, where EBITDA is gross profit minus SG&A of $9,700. Additionally, the value of the machines are going to go down, and that value, it will decrease. We indicated was $2,500 per year, and that's going to happen every year. So fix that reference, copy it across, so that you can then get yourself to EBIT, which once again is just 2 up minus 1 up, or EBITDA minus depreciation, which then if we copy and paste across, tells us he's making like $7,200 for which a bank could lend him and then charge him interest. In this particular case, we don't have any interest indicated. It's not like when we borrowed in the last problem and we thought of cash flows net. Those cash flows net would have included any interest we paid. Here, Cam's not borrowing. So we're just going to then calculate what we call EBT by being EBIT minus interest, which shouldn't change it at all because we have no interest expense. HBP. Lastly, then, just like the video, we have to calculate the taxes after he's now deducted all allowable expenses. So at $7,200 in taxable income, or EBT, earnings before we take out tax, when you pay a 20% tax rate, Jim's second biggest expense in terms of cash flows is really paying tax. He's got to pay the kid, and he pays the kid $4,800 a year, but then he's got to pay the tax for running a successful business. And because this 20% is sitting there and doesn't change, I'm going to lock that one too and copy and paste it across. Thereby, when we think about net income for Cam's batting cages, with the $7,200 worth of EBIT less his tax, it looks to me like $5,760 is the amount of his new net income, which does that not equal what I had in the PDF? Can someone look real quick? I have 20. What should it be? Oh, instead of 2,000, thank you. 2123. Change the input, and magically, is it 6160? Oh, I forgot the raise. Boy, y'all are good. You missed that, or you caught my miss. Excellent. When he gets paid in the following 2 years, we could do something like this if we wanted. Year 2 and year 3, for example. How much will this kid get paid in year 2? $10 in his original, plus he gets a 20% raise, doesn't he? So in year 2, he'd make $10.20. And in year 3, he would make the $10.20 he used to make, plus a new 20 cents. So by the end of year 3, he's now making $10.40 per hour. So the cost of goods then, instead of looking at this number here for the wage rate, notice it's in light blue as B19. Instead, let's change that pointer to be the relative one so that it's now $10.20 per hour for 20 hours per week for 4 weeks times 6 months, means his cost of goods is going to go up by a whole $96 in the year 2. And if I've built that right and copy and paste it across with a relative reference now, I've got E20, $10.40, multiplied by 20 weeks, 4 weeks per month for 6 months, so that by the end of the 3rd year, the new batting cages at CAM should earn him $6,006.40.